Now, just to bring more clarity to your brain, take two examples so that you get into the clarity. Write down the example. DLI Limited. DLI Limited. What is DLI? Dreams Learning Innovations. DLI Limited holds 100% shares. Holds 100% shares of DME Limited. What is DME? Dreams Medical EduTech. DME Limited, which is an Indian company. Which is an Indian company. Now, DLI Limited acquired. DLI Limited acquired jewelry on 1/1/1980. On 1/1/1980 for rupees 1 lakh. For rupees 1 lakh. Brackets. Fair market value as on 1/4/81, as on 1/4/81 is rupees 2,50,000. Is rupees 2,50,000. Now, DLI Limited sells jewelry to DME Limited, sells jewelry to DME Limited on 30th/7/2004 for rupees 20 lakhs. For rupees 20 lakhs. Now, DME Limited sold the jewelry on 1/1/2007. Sold the jewelry on 1/1/2007 for 5 lakhs. For 5 lakhs. On 31/12/2011, on 31/12/2011, DLI Limited sells 25% of the shares, sells 25% of the shares of DME Limited, of DME Limited. Discuss the tax implications. Discuss the tax implication. Friends, first try to understand actually when that particular jewelry is sold by the DME Limited. When that particular asset is sold by the DME Limited on 30th/7/2004. We are not prohibiting the subsidiary company to make sale of such capital assets. Only we want those two conditions to continue to be satisfied. What are those two conditions? Such a capital asset must not be converted into stock in trade for 8 years, and 100% holding company should not cease to be 100% holding company for how many years? 8 years. So, in 2005 and 6, when DLI Limited transferred that particular capital asset to the DME Limited, 47 is perfectly applicable. At that point of time, yes, there is a very good intention to satisfy those two conditions, and happy well 47 is invoked and the transaction is not regarded as a transfer. So, no capital gains will arise in the hands of the DLI. In the hands of the DME Limited, when such capital asset is getting transferred in 2007 and 8, you please remember it is a long-term capital asset. Long-term capital asset. How come it is a long-term capital asset? Period of holding of the previous owner will be added to the period of holding of the present owner, and the cost to the previous owner is the cost to the present owner, and the benefit of indexation will be given from the year in which the previous owner is holding, or 1981-82, whichever is a latter. Of course, since this particular asset is acquired by the previous owner, that is a DLI Limited, on 1180, I can very well take the fair market value of 2,50,000 rupees as the cost to the previous owner, as the cost to the present owner, and can give the benefit of indexation and can compute the capital gains. Yes, this is perfectly okay. But what happened? Subsequently, DLI Limited ceased to be the the 100% holding company. When it ceased to be the 100% holding company? 31/12/2011. Whether that 8 years period is over, let us check. When the asset is getting transferred by the holding company to the subsidiary company, that is 30th/7/2004. From 30th/7/2004 to 31/12/2011, you just see 2005 1 year, 2006 1 year, second year, 7 third year, 8 fourth year, 9 fifth year, 10 sixth year, 11 seventh year. So that means by 31/12/2011, please do remember 8 years are not completed. So before completion of the 8 years, holding company is ceasing to be the 100% holding company. So naturally 47A comes into play. So earlier allowed exemption will now become taxable. Once earlier allowed exemption will now become taxable, please do remember such a rectification order could be passed before what time? When the violation happened on 31/12/2011. This previous year is going to get ended by what? 31/3/2012. From the end of that particular financial, from that particular day, for 4 years, very well, that is 154 rectification can take place. 4 years means 13, 14, 15, 16. So till 31/3/2016, the rectification can be well taken place, and the earlier completed assessment whereby it is not regarded as a transfer of the year of 2005 and 6, rectification can take place till 31/3/2016 is a point. Thanks. But at the same time, even the assessment of this particular subsidiary company also gets changed, because subsidiary company sold that particular asset. At that point of time, how the capital gains is computed? How the capital gains is computed, friends? Cost to the previous owner is taken as a cost to the present owner, and then benefit of indexation and all is being given. Now once 47A comes into play and capital gains is being paid by the the transferor company, the cost in the hands of the transferee company is the price at which it purchased. 49(3) comes into play, and accordingly whatever the assessment of 2007 and 8 which is completed again gets revoked, and again freshly a fresh computation need to be. If 47A comes into play, what will happen? Cost will be what? cost at which the asset is purchased, and period of holding of the previous owner will not be added to the period of holding of the present owner. Got the point? And the benefit of indexation will be given only from the year in which this particular asset is acquired. So at final level you can expect questions of this sort, and we expect you to write the answers with this clarity. So how the answer is to be presented, write down. Position prior to application of, position prior to application of section 47A, section 47A. DLI Limited, DLI Limited, assessment year 2005 and 6, assessment year 2005 and 6. No capital gains, no capital gains shall arise on sale of jewelry, on sale of jewelry to the DME Limited, to the DME Limited by virtue of section 47, by virtue of section 47. Then DME Limited, next DME Limited, assessment year 2007 and 8, assessment year 2007 and 8. First, period of holding, period of holding. What is the period of holding? Just now we have discussed. In a modes of transfer prescribed under section 47, period of holding of the previous owner are being added to the period of holding of the present owner. So period of holding 1/1/1982, 1/1/1982, 31/12/2006, 1/1/1982, 31/12/2006. So hyphen long term. So based on that the asset is a long term. Then cost of acquisition. Of course, at the final level what we are expecting, friends, you to write that basic sections. Period of holding is being discussed by which section, friends? 2 clause 42A. 2 clause 42A. Then cost of acquisition, cost of acquisition as per section 49(1), as per section 49(1), read with section 55, read with section 55. Why these two sections? Just remember, 49(1) says cost to the previous owner is the cost to the present owner. Section 55 says what? In respect to the assets which are acquired prior to 1481, cost or fair market value, whichever is higher. So that's the reason why you should write. We are also expecting you to write and quote these particular sections. That is, cost of acquisition as per section 49(1) read with section 55. This presentation is most important. 2,50,000. Now, computation of capital gains. Computation of capital gains. Sale price 25 lakhs. Indexed cost of acquisition. Indexed cost of acquisition 2,50,000 divided by 100 whole multiplied by 519. See, in the exam don't get bothered. They are definitely going to provide you with the information of index of that particular year of transfer of 2006 and 7 being 519. So that makes it to what? 12,97,500. 12,97,500. Now the resultant capital gain is, balance is, capital gains 12,02,500. 12,02,500. Now next heading, position after application of section 47A. Position after application of section 47A. Why 47A is coming into play, friends? Why 47A is coming into play is for the simple reason that the holding company ceased to be the 100% holding company is a point. So write down section 47A. Section 47A shall be attracted since holding company ceased to 100% of the share capital, 100% of the share capital for 8 years. For 8 years. Accordingly, rectification of the assessment of 2005 and 6 is to be carried out, and it can be rectified up to 4 years, from the end of the financial year in which violation of a condition takes place. That is up to 31/3/2016. Up to 31/3/2016. So how do you calculate, friends, that particular capital gains? Write down capital gains on sale of jewelry, period of holding, 1/1/1982, 1/1/1982, 29/6/2004. So naturally, what is it? Long term. Then cost of acquisition 2,50,000. Now sale price, what is the sale price? That is actual sale price of 20 lakhs. 20 lakhs less indexed cost of acquisition, 2,50,000 divided by 100 into 480 makes it to 12 lakhs. So balance is a long-term capital gain. What is a balanced long-term capital gain, friends? 8 lakhs. Then one last important point is what? even the assessment of the S Limited should undergo for a change. Because earlier in the hands of the S Limited, what you have taken as a cost to the previous owner is the cost to the present owner. But once 47A got invoked and in the hands of the holding company, earlier completed assessment got rectified. Now here normal procedure should go. What is that normal? Write down. Assessment in the hands of DME Limited. Assessment in the hands of the DME Limited. Who is DME Limited? That is a transfer company, subsidiary company of DLI Limited. The SSC can file rectification. The SSC can file rectification under section 154 or a revision application under section 264. Under section 264. Next, the income of DME Limited for the assessment year 2007 and 8, for the assessment year 2007 and 8 shall be recomputed. Shall be recomputed. What is it, friends? Period of holding 30th 6 2004 to 30th 6 2004 to 31 12 2006. Why? Because once 47A comes into play, previous owner cost will not be taken as the present owner's cost. Previous owner period of holding will not be added to the period of holding of the present owner. Only from the date when the present owner acquired that asset to the date when the present owner is making sale, only shall be taken as the period of holding. So sale price 25 lakhs, cost of acquisition less cost of acquisition as per section 49(3), as per section 49(3), 20 lakhs, and what is the resultant is a 5 lakhs, and that 5 lakhs is a short term capital gain is a point. That is to be taken as a short term is a point. See, 43C and under what circumstances 43C is going to be invoked is what we have discussed. You can take one small example on that also. That is, take an example and here try to understand, friends. 43C, which discuss about the cost of acquisition under some special circumstances, is only applicable in situation of capital asset getting transferred as a stock in trade, in case of amalgamations, in case of partial partition or complete partition of the HUF, or in case of transfer by irrevocable trust or by gift or will. But 43C will not have any application in a situation of holding companies transferring to subsidiary company or subsidiary company getting transferred to the holding company a particular capital asset as a stock in trade. There 47, that is 4 and 5, to that there are provisos. Based on those provisos we have done with. Right. So you can make two examples. First, write down DLI Limited holds 100% of the shares of DME Limited, which is an Indian company, Then head, that is DLI Limited, purchased a land on 1/1/1987 for 1 lakh. And the same is sold to S Limited, on 1/1/2002 for 10 lakhs. Then sold to which? Not DME Limited. Yes, DME Limited on 1/1/2002 for 10 lakhs. Then DME Limited converts the land into stock in trade, of its business on 20th/2/2007. When its fair market value is 16 lakhs. Then DME Limited sells the stock in trade on 1/1/2012 for 17,50,000. Discuss the tax implications. Friends, I am not expecting you to write the answers. Only just listen how you have to develop the solution. It is a continuation of what we are discussing. In the earlier problem, what we have done with, there it is a case of what? First condition getting violated. That is 100% holding company ceased to be the 100% holding company. Whereas in this particular problem, second condition is violated. What is the second condition? Transferee company should not convert it into stock in trade, such asset, for 8 years. See what happened, that is that condition got violated because when this asset is transferred by the DLI Limited to the DME Limited on 1/1/2002, and by what time it is being converted into stock in trade? 20th/2/2007. So 8 years period is not elapsed. So naturally what will happen, that is the assessment of 2002 and 3 of the DLI Limited requires rectification, and earlier allowed exemption will now become a taxable, and now becomes means earlier allowed assessment only will get rectified, and on its being rectified you have to again calculate what is the period of holding. Period of holding is the from the date of acquisition by the DLI Limited 1/1/1987 to the date of transfer 31/12/2001. Since the period is more than 36 months, naturally what is happening is a long-term capital asset. What is the sale price? 10 lakhs less indexed cost of acquisition, 1 lakh into 426/100. Right. Finally, the answer there comes is 6,95,714. So for your calculation, you as a hint you can write that is a capital gains to be taxed in the hands of DLI Limited is 6,95,714. Now the point here is like in the hands of the DME Limited. In the hands of the DME Limited, what is the point, friends? What is the point? That is, two incomes do arise. What are those two incomes do arise? One is profits and gains from business and profession. Second is a capital gains. What is profits and gains from business and profession? Actual sale consideration minus what is it? The fair market value as on the date of conversion. What is the sale consideration? 17 lakhs 50,000. 17 lakhs 50,000 minus what is the cost of acquisition, friends? 16 lakhs, because it is the price at which it is purchased. So 1,50,000 is the profits and gains from business and profession, and you have to compute the capital gains. Of course, here what is a period of holding? When the asset is acquired by the DME Limited 1/1/2002, from 1/1/2002 to the date of the conversion. What is the date of conversion, friends? 20th/2/2007 is a point. So naturally it is a long-term capital asset, and the cost of acquisition as per 49.3, because 47A is invoked, you have to bring 49.3 here. Actual cost, price for which it is purchased 10 lakhs, and sale price is what is it? 16 lakhs. That is how do you calculate the capital gains on capital asset getting converted into stock in trade, friends? What is the fair market value as on the date of conversion? That is 16 lakhs minus indexed cost of acquisition. In this case, of course, you have to divide with the index of that 2002 and 3 and multiply with the index of the 2007 and 8. That is divided by 426 multiplied by 519. Thereby the final answer of long-term capital gain will be 3,81,690. As a hint, you can write in the hands of the DME Limited, PGBP is 1,50,000 and long-term capital gain being 3,81,690. So total income works out to be 5,31,690. See, we are more bothered about the concept than the calculation part of it. If a concept wise you are clear, there is nothing like that. So that is basically the point which we want to drive, and you should remember this particular point, that the capital asset must be transferred as a capital asset. In case if the capital asset is getting transferred as a stock in trade, then what is it? Your 47 proviso comes into play is not a case in case of amalgamation, is a point to be well remembered. So for that you just write down one point, one more example. A Limited, a manufacturing company, A Limited, a manufacturing company got amalgamated with the B Limited, being an Indian company, on 10/3/2003. On 10/3/2003, B Limited is in the business of real estate. A Limited purchased a factory. Factory land on 1/1/1986. On 1/1/1986. for rupees 1 lakh, for rupees 1 lakh. And the land is sold, and the land is sold to B Limited, on 10/3/2003, on 10/3/2003, in a scheme of amalgamation, for rupees 20 lakhs, for rupees 20 lakhs. B Limited receives the land as stock in trade of its real estate business, Then the stock in trade is sold by B Limited on 1/1/2012, for 24 lakhs, Discuss the tax implications. Of course, we discussed sufficiently. You can just listen how the solution is to be developed. Fundamentally, you should write the point that section 47 will not have any application, because in a scheme of amalgamation, only when capital assets are getting transferred by the transferor company to the transferee company, then only the exemption under section 47 comes into play. It shall not be regarded as a transfer, right? Whereas your 43C comes into play, that is in the hands of the transferee company. That is, in this particular case, who is the transferee company? It is a B Limited. For it, what is the cost? What is the cost to the previous owner? What is the cost to the previous owner? Previous owner A Limited acquired the asset at what value? At what value? It is 1 lakh. And now the point here is, for C Limited, two incomes. One is what? For that particular B Limited, the cost will be 1 lakh, and at what price it is making a sale? It is making a sale for 24 lakhs. So once it makes a sale for 24 lakhs, 24 lakhs minus what is it? What is the cost at which it acquired this particular land? 1 lakh. 24 lakhs minus 1 lakh, 23 lakhs becomes the, what is it? The profits and gains from a business and a profession. See, once 43C comes into play, it is a simple case. That is, B Limited purchased this particular asset as a stock in trade, and it is making sale of the stock in trade. So what is the sale price minus what is its cost of acquisition? What is the sale price? 24 lakhs. What is the cost of it? Is 1 lakh. So 24 lakhs minus 1 lakh is what? 23 lakhs is a point. So not the, what is it, actual price at which it is acquired. So please make note of it. The solution you can write so that you can go with a clarity. That is, in a scheme of amalgamation, if a capital asset is transferred, as a stock in trade, as a stock in trade, 43C comes into play. 43C comes into play. And accordingly, cost to the transferee company will be cost to the transferee company will be cost to the previous owner plus improvement cost plus improvement cost plus costs associated with the transfer, costs associated with the transfer. Accordingly, in the hands of the B Limited, accordingly in the hands of the B Limited, when such stock in trade is sold, when such stock in trade is sold, gain arising will be taxed, gain arising will be taxed as business income. And the business income shall be what is a business income, friends? The business income shall be the difference between the sale consideration, and cost to the previous owner. In the given example it is 24 lakhs minus 1 lakh, that is 23 lakhs. In saying so, what is the good intention? Law want to give the benefit to the transferor company. Law want to give the benefit to the transferor company. Accordingly, no capital gains is being taxed there by invoking section 47. So in case of amalgamations, in case of partition of the HUF, and in case of transfer by way of a gift and all, even if capital asset is getting transferred as a stock in trade, the benefit of section 47 still continue to be there, which is not the case in case of holding company transferring to the subsidiary company or subsidiary company transferring to the holding company. So write down, no capital gains will be taxed in the hands of A Limited, no capital gains will be taxed in the hands of the A Limited by virtue of section 47. Section 47. So friends, we should get into a complete clarity on what we have discussed. To get into such a clarity, I am putting the entire discussion into 4 cases. First case 1 is what? Either the holding company transferring to its 100% subsidiary company, or 100% that is 100% subsidiary company transferring to its holding company a particular capital asset as a capital asset, then in the hands of the transferor company it shall not be regarded as a transfer by virtue of section 47. And what is the cost to the transferee company is the cost to the previous owner is the cost to the present owner as per section 49(1). What is the period of holding? Section 2 clause 42A says what? Period of holding of the previous owner shall be the period of holding, shall be added to the period of holding of the present owner. And in case if the asset is acquired by the previous owner prior to 1/4/1981, then cost or fair market value as on 1/4/81, whichever is higher you have to take, which is given by section 55. And in case if such capital asset is converted into stock in trade subsequently within 8 years, or holding company ceased to be the, what is it, the 100% holding company, then 47A comes into play. Then recomputation has to happen of that particular income of that particular holding company. And subsequently when the subsidiary company, which is the receiving company, transfers such capital asset, cost of acquisition will be the cost at which it is purchasing. So these many provisions, the clarity must be there. Second case is what? Capital asset is transferred by the holding company to the subsidiary company, or subsidiary company to the holding company as a stock in trade. If that is the case, section 47 exemption is not available. And therefore, whatever the chain of sections which we have discussed, they will have no application, because once holding company transfers the capital asset as a stock in trade, then happy well 47 will not have any play, only 45 will have, 45(1) will have a play, and in the hands of the holding company capital gains will be computed. And subsequently when this particular stock in trade is sold by the subsidiary company, PGBP, profits and gains from business provision. This is the case with the holding company transferring the share, transferring the capital asset to the subsidiary company as a capital asset, as a stock in trade. But this will not hold good once it is a case of amalgamations or partition of the HUF or gift or will or irrevocable trust. So whole clarity just you write, put it in cases, write down. That is case 1. Case 1. Capital asset is transferred as a capital asset. Case 1. Capital asset is transferred as a capital asset. Then such transfer is made by holding company to the subsidiary company, holding company to the subsidiary company, that is 100% holding company to the subsidiary company, or subsidiary company to the holding company, or subsidiary company to the holding company. The following are the tax consequences. The following are the tax consequences. A. Section 47. Make a hyphen. It shall not be regarded as a transfer. Then section 49(1). Cost to the previous owner is the cost to the present owner. Cost to the previous owner is the cost to the present owner. C. Section 2 clause 42A. Section 2 clause 42A. Period of holding of the previous owner, period of holding of the previous owner shall be added to, period of holding of the present owner. Then section 55. In case previous owner acquired this particular asset prior to 1481, then the cost shall be cost or fair market value, cost or fair market value as on 1481. Then section 47A, section 47A, subjected to violation of conditions, earlier allowed exemption will be taxed. Section 45(1). In the usual manner, capital gains is to be computed. Section 155, rectification within 4 years. Of course, we have discussed, just as a hint I am giving you. But verbatim of it, I think all of you know, within 4 years from the end of the financial year in which the violation took place. And section 49(3), rectification of cost of acquisition in the hands of transferee, that is price at which it acquired. So these many sections should be kept in your mind. That is the reason why we spend so much of the time, because this is a fertile area from the final point of view. Case 2. Capital asset transferred as a stock in trade. Capital asset transferred as a stock in trade by 100% holding company, by 100% holding company to its Indian subsidiary, or vice versa, that is 100% subsidiary to its, that is a holding company which happens to be the Indian company, or vice versa. Then what you should write? Section 47 exemption is not available. Section 47 exemption is not available, and in the usual manner, capital gain is to be computed under section 45(1). Then friends, case 3. Capital asset is transferred as a capital asset. Capital asset is transferred as a capital asset. A, in a scheme of amalgamation. B, on partition of HUF. C, by gift, will, irrevocable trusts. Then there the points are: A, it shall not be regarded as a transfer, hyphen section 47, 49(1), Next is cost to the previous owner is the cost to the present owner, 49(1). Then section 2 clause 42A, period of holding of the previous owner, should be added to period of holding of the present owner. And section 55. Of course, I am not making you to write that because all of you know section 55 is capital asset acquired prior to 1/4/1981, costs are fair market value as on 1/4/81. The last thing is most crucial. Write down. Capital asset is transferred as a stock in trade. Capital asset is transferred as a stock in trade in case of amalgamation, comma, on partition of HUF, comma, gift, will or irrevocable trust, of course, happy well you can go for 47. That is, it shall not be regarded as a transfer -47. It shall not be regarded as a transfer -47. Then 43C. Cost to the present owner is cost to the previous owner plus improvement cost plus expenses incurred for transfer. So when you look at all these four cases, utmost care is required and understanding must be there. Capital asset transferred as a stock in trade, exemption is still available in case of amalgamations, partition of HUF and the your transfer by gift, will or irrevocable trust. Whereas once capital asset is transferred as a stock in trade in case of transfers between holding company and subsidiary company, then 47 will not come into play. Straight away in the usual manner you have to calculate the capital gains as a point. Elaborately we have discussed these points.